First it was tariffs, then no tariffs. They're on again, then they're off again, back and forth, round and round we go. So what's the latest news? Donald Trump just announced new tariffs aimed at almost all foreign producers who sell products inside the United States. These so-called Trump tariffs range from 10% tariff against Colombia to a 46% tariff against Vietnam. President Trump has said that the Trump tariffs are necessary to equal out the balance of trade between the U.S. and foreign countries. Trump says that other countries are ripping us off by selling their goods and products inside the United States while imposing barriers to selling our goods or services inside their countries. And he believes that tariffs are the solution. But what people want to know is how this will affect their wallets. So today, I'm going to update you on where things stand currently and how you might be impacted and what you can do about it. Please take a moment to subscribe to my channel and smash that like button so you'll be notified each and every time we drop a new video. Tariffs are basically taxes on products that are made elsewhere than sold in the United States. Tariffs are paid by U.S. businesses that import these products. President Trump has said that there will be a minimum of 10% tariff on nearly all U.S. imports. He has also said that if foreign countries impose reciprocal tariffs against the United States, we will impose even higher tariffs against them in return. All of this means that we are very likely to see higher prices on many goods and products across the economy as the cost increases make their way through the supply chain. But these price increases won't be applied equally. Some items are likely to see prices rise much more than others. Clothing, electronics, auto parts, and metals are likely to see the biggest increases. These businesses will have to absorb these price increases by either accepting a lower profit margin on every dollar of revenue or by raising the price it charges customers in order to maintain those profit margins. I want you to drop a comment below to let me know which one you think is more likely. Are companies going to lower profits or are they going to raise prices? My vote is significantly higher prices to come. It would seem that a lot of Americans feel the same way. In the financial markets, they have something called the Consumer Sentiment Index. Google tells us that the Consumer Sentiment Index measures how consumers feel about the economy and their outlook for the future. It's a key indicator of the country's economic health. Consumer sentiment is also important because it can influence spending and investment decisions, which in turn impact economic growth. If consumers are optimistic, they are more likely to spend and invest, which boosts the economy. But on the other hand, if consumers are pessimistic, they may cut back on spending and investment, potentially leading to a slowdown or maybe even a recession. The U.S. Index of Consumer Sentiment is at a current level of 57, which is down from 64 last month and down from 79 1 year ago. So essentially, just 1 year ago, 80% of Americans felt optimistic about the economy, whereas today only 57% of people feel the same way. So consumer sentiment continues to decrease, meaning that more and more consumers are pessimistic about the outlook for our economy. The stock market seems to be reacting in kind. Have you checked your 401k lately? If not, you probably shouldn't. The S&P 500 dropped more than 10% in 2 days, and the tech-heavy NASDAQ closed in a bear market on Friday, capping one of Wall Street's worst weeks since the start of COVID-19 back in 2020. To say it was a bad couple days for the stock market is an understatement. Now, analysts at major Wall Street firms are now predicting that the U.S. economy is likely to fall into a recession within the next year. JP Morgan, which is the largest bank in the United States, is now saying that the recession could come as early as the third or fourth quarter of 2025. But it's not just the U.S. markets that are panicking after the Trump tariff announcement. Investors around the globe sent President Trump a clear message about his new tariff policy, and the message was very resounding. They don't like this. Since Donald Trump's inauguration, financial markets in Germany, the UK, and Canada, and Japan have all plummeted just about as much as our own. Overseas, many countries, including our biggest trading partners, have already levied tariffs against American products. The U.S. agricultural industry is bracing for potentially tens of billions of dollars in losses after China announced their own tariff counterpunch in the form of a 34% tariff against U.S. imports. Now, the 34% tariff is in addition to the 10 to 15% tariff that has been in place since Trump's 2018 trade war with China. So this is bad on top of bad. American farmers who overwhelmingly voted for Trump could potentially see losses of over $30 billion in 2025 alone. That's because China currently buys about 14% of all U.S. agricultural exports. You think about things like wheat, grain, soybeans, etc. We grow them here in the United States, ship them over to China. And with them imposing tariffs against our products, it's just an all bad situation for farmers in the Midwest. So it's obvious that in just a couple of months of being in office, President Trump has plunged the U.S. into another trade war, this time with the entire world instead of just China. But the president has said that the pain we are feeling now and likely to feel for the next few months or maybe even years is only short-term in nature. He says that the long-term impact of his strategy is that companies will decide to manufacture their products in the USA rather than facing the Trump tariffs. For example, manufacturers of products that are heavily impacted by tariffs like electronics or car parts might decide that it makes more sense to set up production facilities within the U.S. rather than pay the tariff. If more businesses come into the U.S., that would mean more jobs and an expanded tax base, driving in more revenue to the government. I know this is not good news, but there are things that you can do right now to get ready for a possible recession. Number one, review your financial priorities and make sure you're focusing on what's most important. Number two, pay down your debts. If you have some cash, better to be out of debt going into a recession than be heavily weighed down by a debt burden. Number three, make sure your resume and your career networks are both up to date. Number four, try to boost your emergency fund. Finally, create an investment plan and stick with it. Don't make decisions out of fear. I want you guys to drop a comment below if you think I should make a full video covering what you should do to prepare for a possible recession. Drop the comments. If you guys like it, I'll make a whole video detailing those things. So, in conclusion, the Trump tariffs are here, and it appears that they're here to stay, at least for now. The markets are already reacting to what the financial experts see as a very bad thing for the economy. Experts are predicting higher prices and the potential for a recession later this year. We don't really know how bad things might get because it depends on how long these Trump tariffs remain in place and to what extent other countries impose reciprocal tariffs on the United States. So we know that these things might be headed our way. I say take the time now to prepare, both mentally and financially, for whatever else might be coming. Well, that's it for this week, guys. Talk to you later. Bye.